with today's probateweekly.com. We get together every Thursday at 4 p.m. to discuss all things probate real estate. We have investors, wholesalers, realtors, executors, administrators, vendors, to learn about how to be more effective in the probate space, specifically running real estate. Feel free to ask any questions. The idea is to be participative. It's not a webinar. I could record this and just show it as an interview, which I've done. But this call is designed to be participative because I really believe that we all need to engage more, work together more, find more people to work with and support. So if you're on the Zoom call, which I recommend coming in at probateweekly.com, feel free anytime to put a comment in the chat box, try to watch them all, or unmute yourself at an appropriate time and ask a question. You can do that or raise your hand. If you're watching a live stream, we're on YouTube and Facebook and other channels as well. Put your comments there, and as best as possible, I'll look for those comments and answer them as well. So we want to make this as participant as possible and help you learn and grow. The purpose of this, I'm not selling anything. I don't sell data. I don't sell a coaching program. I'm a real estate broker. I sell houses. My goal is to work better with each other to help us all be more successful in our respective businesses, or to help us increase our income and to increase our wealth. We're excited. We have a sponsor now. We've got very high scale. Mailbox Power is our sponsor. If you're watching the live stream, you'll see there's a link there. Mailboxpower.com/8C as in Charlie, X-ray, 5WT as in Tom. If you go there, you get a free trial and learn about how to use that to build your business, particularly effective with current customers and past clients. So if you're interested in how I work that into my business, reach out to me, call, text, email me. I'd be glad to help you with that. And also to point out this week, there's a great article in the California Lawyers Magazine by Paul Horn, who is the teacher of the California Association Realtor certification program for realtors in probate. And he kind of describes the whole process of real estate and probate from his perspective. It's a great article. So again, if you're interested, email me at bill@LAProbate.com. I'll be glad to send you back a copy of that article if you're interested. Okay, so why do we do this? You know, I think sometimes when I talk to real estate agents or investors or wholesalers, they expect to come on a call and I give the magic pill. And if they take the pill, they're going to get, say, 2 listings next week. And that's not how it works. In particular, in probate, the way it works is the more valuable you become, it's a process, the more business you get in the long run. How do you become more valuable? By learning the business, you learn how to work with the different parties, the different vendors. And one of the parties that you work with in probate from time to time is accountants. I'm really lucky in that I will really almost a lifetime friend, though he looks to be my son's age maybe, but a lifetime friend from college who is one of the leading certified public accountants in Southern California, particularly in complicated trusts and probates, guardianships, and serviceships, David Ellis. So I'd like to welcome my good friend, David Ellis. Say hi, David.
Thanks, Bill. Thanks for having me.
My pleasure. So I know that we went to college together, USC. Give us a little background. Where did you grow up and how did you end up in the accounting profession?
Well, I'm from Southern California and as you know, hit the debate circuit in high school debate from Alhambra High right here in the San Gabriel Valley. And many of you may not know it, but Bill Gross was a very prominent high school and a college debater. And we wound up at USC on the debate team together and traveled all over the country, you know, trying to give it to all these other various college debate teams. And we did quite well, particularly Bill. And I had originally intended to go to law school. And after graduating from USC with a degree in communications, which about 90% of the people on the debate team, you know, had that particular degree, I decided to follow in my father's footsteps, who had been a longtime CPA. Oops, I forgot to turn off my phone. Very sorry about that. Let me fix that. Still getting used to the new technology here. Anyway, I started working with my father, who had a CPA firm, and about 15 years ago, at the ripe old age of 80, he went blind in one eye, and I had long since become a CPA and had been working with him. So I bought him out and took over the firm and put the emphasis in primarily in tax. My three areas of expertise are divorce, trust, and estates, and have been working as the managing partner of the firm since about 2006 or so. And that's how I got here.
And so talk about specifically the process of accounting as it relates to estates, and then probate occasion when there's disputes and related material. How do you get involved in that, and how do you develop that expertise?
Well, it really started by virtue of the fact I wanted to, tax is always the area that interested me in accounting. And before I was a CPA, I was an enrolled agent. And an enrolled agent is somebody who passes an IRS exam. It's a 3-day exam. And it's very difficult, and it's strictly just on taxes. And while I studied for the CPA exam and took the accounting courses that were necessary to get the CPA license, I practiced taxation as an enrolled agent. And what the areas that interested me were things that a lot of other people didn't do. And I noticed there were not a lot of people who specialized in divorce, and there were more that specialized in trust and estates. But the number's not huge. A lot of tax practitioners just don't do it. And it was attractive to me because it's a specialized area, it's a complex area, there's always something new. You have a lot of it's kind of a convergence of law and accounting and governmental oversight. As you know, trust and estate law is a combination of the trust agreement and the federal tax law and the state tax law all coming together in the same place. So, the running joke in trust accounting and tax practices, the good thing about it is it's so complicated, nobody knows when you're wrong. So I thought, well, that sounds like a perfect place for me. And it's turned out to be a fun, lucrative area.
Now, I would think that you're an accountant, and obviously part of your business, but you're a businessman whose service is accounting. I would imagine at some point part of your business activities is business development. So what do accountants do to build business, and what do you do specifically to do business development in your particular practice? Or have you?
Well, what I did, and I think anybody could do it in any profession, is I put my very, very expensive speech communication degree from USC to good use in practice by hitting the speakers circuit. And I would go to business clubs, Rotary clubs, you name it, and I would just start to give lectures on usually qualifying for continuing ed credit on various tax matters. And it was a lot of fun, and it's a great way to develop connections. You develop a reputation as being an expert in a particular area. Of course, my father always used to say, an expert is just somebody who has a briefcase and travels more than 50 miles. But I guess with the Zoom technology and things like that, that's not quite the case anymore. So that was my primary means of business development. And then I started writing articles of interest and getting published in various business magazines and tax journals and things of that nature. So I would encourage anybody to do that who wants to develop any interest. Find some specialty area in whatever it is that you're doing. And people are hungry for information, and get it out there, and you'll be amazed at how quickly your business can grow, at least in my experience.
Imagine one of the groups that you market to is attorneys.
Attorneys, other CPAs, real estate people is a good one. There are a lot of very specific tax items that can be very helpful in real estate sales. Hopefully we'll have a chance to discuss some of those today. And I would go out and explain to the realtors why if your clients are putting their property in joint tenancy, they might be making an enormous tax mistake as opposed to community property. Or, this may sound a little lugubrious, but why, if you have the death of one spouse, particularly if somebody's been in a home or a property for a long time, it might be an opportunity to help them liquidate that property without paying a single penny in federal or state income tax. And in fact, you might even be able to generate a tax loss that they can utilize against their other income. So, I would go out and talk to real estate groups about things like that and, give them information that will help them develop their business that they can put in their sales, sales material and things like that.
I think you made a good point that, as a real estate agent, particularly in Los Angeles, being such a large market, the market's so huge that you can specialize with a specialization, as I have. You could just chase probate business through accountants or attorneys or fiduciaries or other professionals. And just that one niche, you would be busy with your career if you did it properly. I think you hit it right on the head there. So the most popular request I get on this program from real estate agents and investors in particular is networking with attorneys. Talk about what are some of the best practices, what pitfalls to avoid when looking to develop your business specifically with attorneys in your business.
Well,
be careful now. This is on social media, so who knows where it's going.
I'm sorry?
Be careful now. This is on the social media. So,
well, attorney, and I'm fortunate to work with some, fabulous attorneys, and they're just like everybody else. They're looking for good quality business, and they want to expand their networks. And so, I think I actually heard you say it, is, you can get what you want if you help other people get what they want. And so if you can develop a relationship with an attorney and, hopefully make some referrals, find out who's good in real estate law and start to make some referrals to some people. I've found you don't really need to work with a lot of people. It's better to be deep than wide. And, if you're going to have an attorney referral list, hopefully you're going to find one or two or three that you can really work with closely and refer business back and forth. See, in my experience, it's the old 80-20 rule. I get 80% of my referrals from 20% of my clients. So you're going to want to work with somebody who will refer back to you. But my pitch has always been, unless you're a tax attorney, there's a lot of things that you probably don't know that, can hurt you when you're structuring these transactions, whether it's a sale of a probate sale where somebody has passed away, or a divorce settlement, or whatever it happens to be. So I would recommend find something where you can provide useful information to a lawyer and maybe get it out there on social media or hit the speaking circuit or something like that, and then give referral. Really the best way to get referrals, in my experience, is also to give referrals. So I find somebody that I'm comfortable with, and I start to make those referrals. And if you've made a fair number of referrals to somebody, and nothing ever comes back, well, then you might want to be rethinking that relationship.
Yeah, well, you put out there. So let's try and pack a little bit of that. That was fantastic. And for those of us, who are trying to build our business, it might be new for us. So he rolls off a few concepts really fast. He talked about depth rather than width, right? And so when you're prospecting to a number of people, you're looking for the one or two that really fit with you. And you want to come from a relationship is about putting into it. We value a relationship on the energy we put into the relationship, not what we get out of it. Think about a mother and a child. What does the child really do for the mother while it's an infant? Nothing. Who loves anything more than a mother loves a child? Nothing. So because the mother puts so much into the child, that creates the feeling of love. And so same business, that if you put into a relationship, you can around it, and simple things like information, articles, speaking events, different ways to do that. And I guess one more point that I think you said in passing real quick, if you're really been in business for a couple of years or investor, you already know a couple of accountants or attorneys. Start with them. And I always say this to agents, and they go, well, yeah, but I need new business. No, you've never really developed a relationship with those attorneys. You've just got their information on a deal and done, call them back, develop a relationship, bring some value to them, bring them some information, invite them to an event, invite them to lunch, drop off at Starbucks, build a relationship, all about the relationships. So let me ask you, David, what do you do, or do you not? I know you've been very successful, you've built a huge practice. What do you do to nurture the relationships you have already? I'm sure you have some attorneys, contacts that have referred you business over time. How do you stay in touch with them, or do you? Do you have to at this point?
Well, I think the most important thing is to provide excellent, timely service. The biggest complaints that people have about professionals, in my experience, both CPAs and attorneys, is they don't promptly return calls and they don't promptly produce the work. So, once you get a referral and you get the opportunity and people, send you work, you have to perform in an excellent manner, so you'll get return business. That's the first thing. Be very good at. Oh, did we lose you?
No, I'm here.
Okay, all right. So you have to be very good at what you do and answer calls promptly. All my clients have my personal cell phone. It's the same one that my mother has. So I tell them I'm pretty much available at any time that's reasonable. And if I can't pick up the phone, you leave a message or send me a text or an email, and I'll get right back to you. So that's the first thing. Be good at what you do and provide excellent service. Now, everybody likes, at least in my experience, to be taken to lunch, drop by and drop off some coffee or bagels or donuts or something like that. My preferred weapon of choice is C's candy. For those of you not from Southern California, it's a very famous candy. They make delicious chocolates, and I give that stuff out like crazy at all times of the year, particularly in the Christmas season, and people love it. I'm a little less enthusiastic about it now that somebody pointed out to me that Mary C's, her picture on the box looks just like Mitch McConnell, but I don't want to I don't want to delve into politics, but when you look at the box, she kind of does. Anyway, so
that's a terrible thing to say about Mary C.
Take a look next time you have a box of cheese candy. I'm not kidding. Anyway, that's all the politics I'm going to mention for the time. So find what works for you and what you think people enjoy. And, everybody likes to get a little something. But, when I give a gift to a client or a referral, my only advice would be make sure it's something nice. I mean, I have people give me, some people give me fabulous bottles of wine or, whatever. But some people, bring by just very, something that's not that nice. It looks very, cheap. So I think if you're going to give something really nice so people will remember it, and it says something about you, about what you're giving. That's just my opinion.
Yeah, generally we spend too much money and don't make it about the thought so much about the person and what about them they might appreciate rather than being extravagant. So, okay, so tell me a little bit about we're going to a little technical discussion if we can from an accounting point of view. Do you get involved with, I think we talked about guardianships and conservatorships, do you sometimes get involved in those types of entities? And what are different about those than other trusts or other families that you work with?
Okay, well, most of the guardianships that I deal with come to me from professional fiduciaries. And, come to think of it, that's probably another very good source of business for real estate people, because professional fiduciaries, they are, very frequently in charge of liquidating the estate and the probate, and they get their choice of the professionals that they want to work with, including the real estate person. So those would be people that if I was in the real estate business, I would definitely want to talk to them. Anyway, when a conservatorship is normally where you have a person that has been declared incompetent for one reason or the other. They may have mental health problems. They may be in a coma. They may have Alzheimer's. I think probably everybody heard about the Britney Spears conservatorship, which was very interesting. I'm really not sure why she was in a conservatorship when she was making $24 million a year. But anyway, that's where the court decides that you're not able to handle your own affairs, that you're possibly a danger to yourself or others, and your legal and personal affairs and business affairs are put in the hands of a conservator, and in my case, all of my conservators are professional fiduciaries. And they then become responsible for managing all your financial affairs and filing your taxes. Nothing changes from the point of view of the tax rules for a person in a conservatorship. They're a living person, and they have to file a form, a federal and state income tax return, just like all the rest of us, and all the same rules apply. Sometimes some of the things that are different is you might see, a large expense for medical expenses, or, unlimited health care or assisted living care for an aged person. You have these big expenses as medical expenses. But, basically a conservatorship files taxes just like everybody else, except the fiduciary is filing for you instead of you filing for yourself. Okay, that's very different from a trust or an estate. A trust can be one of many things. Probably the most common type of trust is what people refer to as a so-called living trust, and people use them to avoid probate, allegedly. And these things have no tax consequence while the person is alive. It's basically, it's called a grantor trust. It's ignored for income tax purposes. And for income tax purposes, the trust and the person are the same thing. However, there can be huge differences for estate planning purposes, which is probably beyond the scope of what we want to talk about, today. But a trust can also be where a person has passed away and they've left their assets in trust, which is then administered by the trustee, often a professional fiduciary, often a relative. And the income tax treatment of a trust, irrevocable trust or a non-grantor trust, where the person has passed away or permanently given away the property, is very different than from an individual. And probably the big thing you want to know about trust is they are taxed at a very harsh or compressed rate if there's any taxable income in the trust. So what you typically have in these cases, you want to distribute the money that's in the trust, the taxable income. Generally speaking, you want to distribute it out to the beneficiaries, where in most cases it will be taxed at a lower rate, as opposed to leaving it in the trust and having it taxed at a higher rate. Now, of course, the combinations and variables are infinite. I'm speaking in very general terms here. What we see on the real estate end of it very frequently is, the trust has sold a piece of real estate, maybe the residence of the deceased person, and if there's a capital gain on it, we have to decide where we're going to have that capital gain taxed. And in California and in most states, the trustee has discretion as to when and if to distribute the capital gains and where it's going to be taxed. And again, in general, it makes more sense to distribute it out to the beneficiaries, where it's usually taxed at a lower rate. So those are some of the things you have to look at. And an estate is when a person has passed away, and the tax rules on estate taxation for income taxes are very similar to a trust. Probably one of the main thing to remember is, to the extent the trust or the estate has taxable income and that income is distributed out to the beneficiaries will pay the tax on it. Now, if the estate has no taxable income and all they're distributing is the principal of the estate or the corpus, then there's no tax consequence to the beneficiaries. And the beneficiaries will receive from both a trust and an estate this little report called a K-1, and you receive those when you're the beneficiary of a trust or an estate, or when you're a partner in a partnership, or when you're an owner of an S corporation. And it's basically just a few pages of paper that tell you what your share of the taxable income and other deductions are. And you need that in order to report it on your income tax. And the IRS gets a copy of what you received. So if you don't report it properly on your tax return a year or two down the road, you'll get a very nasty letter saying, hey, we noticed you had $1 million of income from the ABC Trust, in box 7, line 11, and it's not on your tax return. Why not? And if you can't explain it, you're going to owe some tax plus some interest and penalty.
And I think one of the most relevant things for us real estate agents is that almost any real estate sold in California in a guardianship or conservatorship has to have court approval. Whereas a probate's in many cases do in conservatorships and guardianships, almost all need court approval to be sold. You can imagine if somebody is not able to make decisions, the court says, well, we're not going to trust anybody to do that. We want to oversee it ourselves, and there's some strict rules on that, similar to a probate sale. So that's why guardianships and conservatorships can be either complicated for an agent to avoid, or in my case, because it's my specialized in, that's what I'm looking for those problems. David, I've got a question here from Dina. I like the question. I'd love to hear your answer. What type of attorney would you need to contact for a probate client?
An attorney that does trust and estates. That's usually what they're listed under, trust and estates attorneys, and they're specialists. I definitely would not go to a jack of all trades. So sometimes you see a combination of attorneys that do family law and trust and estates. That's kind of a good combination. It's more or less what I do, but you want somebody who has experience, because it gets very, very complicated. Now, the one thing just I want to get out there and not forget about is, when you're selling a property that's been in a trust or an estate from a deceased person, usually you will not have a lot of taxable gain on that, because when a person passes away, the property gets what's called a step up in basis, which I'll just use the example of my own parents. They purchased their home in Monterey Park, California in 1969 for $37,000. And it's a very nice home, and but still very average, nothing special, maybe 1,500 square feet. And it was recently appraised at just a little over $1 million. Now, if my parents, and they're both alive in their mid-90s still, knock on wood, if they were to sell it tomorrow and move into the old folks' home, they would pay capital gain on the difference between the $37,000 that they paid for it and the 1.1 million that, say, it sells for. But they would get a reduction for the principal residence. There's a federal principal residence deduction when you've lived in the home for 2 out of 5 years. For a married couple filing jointly, it's $500,000. But even when you take that $500,000 into account, my parents would still have a taxable capital gain of over $500,000. Okay, now here's what happens when somebody dies. Let's say, my mom finally gets tired of my dad watching Fox News, and she smothers him with a My Pillow. Okay.
God forbid.
God forbid. Oh, there, I went political again. Sorry. Okay, so now he passes away, and when he passes away, because they own the home and community property, the house gets revalued for federal income tax purposes, not for property tax purposes, mind you, but for federal income tax purposes, to the fair market value on the date of death. So if the fair market value on the date of death is 1.1 million, my mom gets back from the funeral. She calls Bill Gross. Bill, you'll come over to Monterey Park, won't you, Bill?
Yes.
Get your passport stamped from the west side and
yes.
come over and slum it with us over here in the San Gabriel Valley.
I'll go through the checkpoint. Yes, no problem.
Okay, very good. Okay, so and Bill sells the house for her. He gets over asking, but she pays a little or no income tax because her basis her investment in the house, as far as the IRS is concerned, is $1.1 million, which was the fair market value when she died. And Bill sold it for 1.2. And so she's got a $100,000 profit. And since it's her principal residence, she has a $250,000 exclusion. So she pays no tax. She skips off, goes to the old folks' home, and then runs away with the pool boy.
Wow, your mom is quite a character.
She is. Look at that. She did in my dad, got away tax-free, and then ran away with the pool boy to Puerto Rico.
Well, let's hope not.
Maybe I better get a conservatorship for her before it's too late.
Explains a lot about you, David. I was wondering about this.
Yeah.
So, okay. So, hey, again, this call is participative. So if you have questions, put in the chat box, raise your hand, and brave enough, just unmute yourself and jump in at an appropriate time. If you're watching this on live stream, feel free as well to put a question in, and I'll do my best to pick up on it and answer it. Dan, what do you put on your normal CPA hat and step out of probate for a second, because we have on here, everybody here makes money, pays some kind of taxes. What do you see as the biggest mistake people make in their personal taxes that you see that could have been preventable, that would save them a lot of money? Is there any particular recurring theme you see in mistakes?
Oh, goodness. Well, high up on that list would be keeping poor records, co-mingling your personal expenses with your business expenses. Makes it very difficult for your poor accountant at the end of the year, and it makes it difficult to prove your deductions, if you're audited by the IRS, and obviously failure to keep receipts, things like that. I think if you're serious about your business, you certainly at a minimum want a DBA and want a separate business checking account, separate business credit cards, and things like that. And, most people, and I can't tell you exactly where the cutoff is, but most people doing $200,000 or $300,000 a year in gross sales, it's probably worth their while to look at incorporating, maybe getting an S corporation, possibly a C corporation. The difference between those two is an S corporation, the income is taxed, flows through and is taxed on the personal return of the owner, and a C corporation is its own taxable entity. And that's a whole nother discussion for another day. But I think failure to incorporate at some point when your operation gets big enough, because there are certain tax advantages that in incorporating in terms of reimbursements. Just to give you an example, you could have a home office, and you could have the corporation reimburse you for depreciation on your home office if you use your home office separately and exclusively. And we make a monthly reimbursement plan for our clients where the corporation reimburses them for all the expenses that they pay on behalf of the corporation, and that way that expense is on the corporate books. It's completely legal and allowed, and it's just a lot cleaner than than using your personal credit card to buy business expenses and things like that.
I would say, just put out there, I have a corporation, and I got proper books, QuickBooks, and I believe everything is in order. We're literally, last December statements and last January filing stuff, my taxes are ready to turn over to a taxpayer. I feel like the first time in my life, I'm not going to be scrambling for anything. It's all been there month after month after month, and we're ready to go. We're excited about that. And to those who are small business people, I just really urge you to take that seriously, because it's just so important, and in the long run, building your business. A question from Irene: if properties are in an LLC, can the LLC be listed in the trust to avoid capital gains?
Not sure I understand the question. Here you have LLCs. Keeping a property in an LLC can present some problems, because basically what happens is, if you have an interest in an LLC, when a person passes away, you have your basis in the LLC goes up, but not necessarily your basis in the property. So there is an election called a Section 754 election that can be made at the LLC level to step up that basis in the property, so the surviving partners get a stepped up basis. But it can get complicated. If you're going to put the property in an LLC, you need to talk to a tax attorney or a CPA and make sure it's properly done. In order to get the step up in basis. And then again, keeping real property in a corporation is not necessarily a good idea also, because you wind up with the lower basis trapped within the corporation that can deny you the step up in basis. Now, that said, if you're talking about a single member LLC, or just in California, in a community property state, a husband and wife member LLC, the important thing to know there is those are ignored for federal income tax purposes. It's called a disregarded entity, okay? So that would be one way to keep the property in the LLC, still get the step up in basis, and still get the liability protection. But when you're starting to put the LLC and the property in a multi-member LLC, other than husband and wife in community property states, you can kind of make a mess for yourself. And the other problem there is the election to step up the basis at the death of a partner has to be done at the partnership levels. And I went through this not long ago where we had a partner that passed away, and there were several hundred partners in the partnership, and we wanted to step up his share of the apartment building. And the managing member of the LLC says, look, we just don't do that. It's just too much of an accounting nightmare for us. So single member LLC, if you elect it to be a disregarded entity, no problem. Multi-member LLCs, S corporations, C corporations can get messy.
Consult your local tax attorney and professional. Very nice. Okay, look, I know this got a little deep and complicated. Part of my goal here is to see how he works with professionals, some of the people we want to work with. Part of my purpose today was to learn how to work with David and professionals like him. So when we're in probate, we are contributing rather than just standing by passively and missing a chance to engage or be of service for our customers. And part of it is he's a successful business person, and we want to always learn from people's success. So other questions, comments, raise a hand, put in the chat box. I know it's good, but the questions we had so far were very detailed and deep. And I want to say, I prepared David to say that, some of this should be fundamentals, and he's fine with that. It doesn't have to be, you don't have to test him and see if he's qualified or not. You can ask him some basic tax advice questions. I'm sure he'd be glad to answer. Anybody have any questions, comments on Skype? So you mentioned the number one. Oh, there's a hand. Let's see there. Patricia.
Hi, Bill. Hi, everybody. I had a question. I just wanted to ask, if you're starting off as a small business owner or, an entrepreneur, whether you're in real estate or starting up another business, what would be the best type of entity to form? Would it be an LLC or which other type of, entity would be best for a solo entrepreneur?
Okay, good question. And the answer to that question is the same answer to most tax question is, it depends. Okay, but as a general rule, I am for a solo entrepreneur where you're the only shareholder or member, you own 100% of the business. I tend to lean toward S corporations as opposed to a single member LLC, because a single member LLC, unless you elect otherwise, unless you elect it to be a C corporation or an S corporation, a single member LLC starts off as a disregarded entity for federal income tax purposes, and most states comply to this. So what does that mean? That means as far as the tax law is concerned, you're just like a sole proprietor, and you file your taxes, your federal taxes on Schedule C Everybody's probably seen that. It's your typical business schedule that goes on an individual return. So, I mean, I don't really see, other than possibly some limited liability protection, I don't really see the advantage of being a single member LLC. Okay. Now, multi-member LLC is a different animal. Now, they have their pluses and their minuses. One of the pluses of the multi-member LLC is they're very flexible. You can structure them so, say you have a partner and you can say, well, you're putting in the money, I'm putting in the work. Let's say we have a loss. Here's what we'll do. You get 90% of the loss, I get 10%, but if we get a profit, we split 50-50. So you can have those profit sharing and those flexibility arrangements in a multi-member LLC. But back to being just one person. I tend to favor an S corporation for one person because it gives you, there's some good tax advantages to it that, we won't really have time to go into, but it gives you the, the liability protection, assuming you keep everything separate like you're supposed to. And you have it's its own taxable entity, which has a lot of advantages. The disadvantages of an S corporation are, you have to file a separate S corporation tax return, cost you some money. In California, S corporations are generally not taxed at the corporate level. The income passes through to the individuals. Although in California, as well as some other states, there's some modest S corporation taxes, like California is 1.5%. So each of these, single member LLC, multi-member LLC, S corporation, C corporation, they all have their pluses and minuses. I tend to like the S corporation for, 100% owners or husband and wife owners. Now, when you have multiple owners, you start to run into other issues, both with S corporations and with LLCs. One of the things I'll caution you about is you want to be very, very careful before you wind up a minority owner in an LLC or an S corporation, and to some degree a C corporation. Why do you want to be very, very careful about this? If you own 49% of it and somebody else owns 51%, that means they get to make all the decisions about how much profit is actually, or how much distribution is actually paid out to cover the taxes. And I've seen people wind up in a situation where they're a minority member in an LLC partnership or in an S corporation, and the income is passed through to them on paper, sometimes a lot of income, sometimes millions of dollars, passes through to them on paper, and the S corporation or the partnership doesn't distribute the cash, okay? And sometimes they don't even distribute the cash, enough of it to pay the taxes. So you can wind up in a situation where you have a lot of money passed through to you in corporate S corp profits or LLC profits, and you have no cash distributed to pay the tax. So it's called phantom income, and it's an enormous problem. So be very careful who you go in business with, and be very cautious about allowing yourself to have less than 50. I guess it would be 50% because they'd be deadlocked. Now, that said, a shareholder and an minority shareholder, you've got legal recourse. You can always sue. You can go to court. You can do this. You can do that. But I mean, who wants to be there? Best to avoid the problem in the first place.
Okay. So here's a question for maybe a little more career advice, like you, like me, David, we're elder states. I'm sure you asked this question from accountants starting out. And so here an agent's asking you advice. What advice would you give a new agent looking to get plugged into the business?
Okay, I'm sorry, can you repeat the question?
What advice would you give a new agent who's looking to get started in the business? Like they're new, they don't have experience, a lot of a deep network yet. What would you advise somebody new who's looking to build a business, and particularly a real estate agent?
Okay, well,
Oh.
I'm going to give you I'm going to disclose to you for the first time on any kind of broadcast my secret weapon. Okay.
Whoa.
And somebody gave me this piece of advice years and years ago, and it was one of the best pieces of business advice that I ever got. And that advice was get up an hour early in the morning and read 1 hour, a minimum of half an hour if you can't do an hour, but no less than 30 minutes in your profession. Okay. And I'm not the first person to say this, or if anybody's ever listened to like Brian Tracy or Earl Nightingale or those kind of people, they all say the same thing. But somewhere along the line, that came my way, and I implemented that fairly early in my career. And it made an enormous difference because, I learned sales techniques. Obviously, you learn in your profession. You learn, in my case, I learned, tax strategy and things like that. And it's even better now because we have voice to text or text to voice. So what I do a lot of times is I download my reading for the day, and I put it on my iPod, and I'll listen to tax journals or business journals or whatever it is that we've scanned and downloaded. So text to voice, in my opinion, is a huge advantage. And start to start to learn things. Learn as much as you can about your profession, about probate, about how the court works. Learn about sales. I mean, I took a wonderful, actually spent quite a bit of money on sales courses to build my practice. There's one I'm particularly fond of. It's called the Sandler Sales System by David Sandler, Sandler. He passed away quite some time ago, but his tapes and books live on. I believe the Sandler Sales Institute is still around, and they have a very unique approach to making a sale. At least it was when I first learned about it. And David Sandler's idea was go for the no. Try to pre-qualify your people as much as you can up front, because the majority of people that you're going to talk to are going to be a no. So if you can get the no's out of the way first, that gets you quicker to the yes. And so I'm probably not doing it justice, but I would encourage anybody to take a look at his stuff. You can just Google him, the Sandler Sales System. And by the way, a very funny man, just very entertaining. One of the things that he used to say is, if they ain't laughing, they ain't learning. So that was well worth the money in my opinion. So
well, that's some gold advice. I just shared the page. I put in the chat box. If you go to Sandler.com, is the Sandler system training that lives on afterwards. So never heard of that. That's a great tidbit. Thank you so much. We've got another question. Do you serve customers in Northern California?
Northern California?
Mm-hmm.
Sure. Yeah. I mean, I actually have customers all over the globe. I have in Australia and Germany and Chile and all over the country. Obviously most of my clients are in Southern California, but these days between email and Zoom and conference calls, the majority of people, I really don't see that many people in person anymore, particularly since the pandemic. So if I can help you, feel free to contact me, and we can have a chat.
Great, and we have his contact information. I'll go over the details at the end. Next question: what would be the best entity for an individual to put a property in, if not an LLC?
Well, again, I think a single member LLC is fine. No problem. You still get the step up in basis, so on and so forth. Other than that, it becomes problematic. Probably my next, a C corporation is generally speaking a very bad place to keep property that's going to appreciate. So my next place would probably be an S corporation, and then probably a C corporation as a last resort.
Got it. And then the next question is, what are your thoughts on using a self-directed IRA for real estate investments to reduce or eliminate taxes?
I candidly haven't seen a lot of that. you need to be careful with these self-directed IRAs. There are a lot of really tricky rules on them. We see a lot of them, and you can wind up with what's it called? Unrelated business taxable income, UBTI, where your IRA actually has to wind up paying tax if things aren't properly handled. It has to file its own tax return. So it's a tricky area. Also, there was just a tax court case. It didn't involve real estate, but it involved a self-directed IRA with gold. And basically, the whole thing was unraveled and ruled to be, I don't want to say a tax scam, but not to be valid for tax purposes because the person exercised too much control over the gold asset. So there's always this issue, an IRA is supposed to have an independent trustee. This is always an issue in any kind of these plans. So I think when properly done, fine, but you need to have somebody who has a lot of experience in that and make sure all the T's are crossed and the I's are dotted because you can get yourself sideways, in a hurry.
The company I used to work with that specializes in self-directed IRA funding for land purchases in greater LA area. Have people take a portion of their IRA, small part, 5%, and buy land and just sit on it. The idea of being there for 30 years, eventually everything goes up in value. It's an interesting concept. And, it's not for everybody, but it was an interesting concept. I've lost touch with that company. So, okay. So I think that's all the questions and we're pretty close to time. Any last second comments or things that you want to mention that you forgot, Dave? Do you want to pass on any pearls of wisdom or things to look forward to in the tax world?
Oh gosh, well, I guess we're all waiting to see what's going to happen with the Build Back Better plan, and if we're going to have some major tax changes. I would say, the things to keep in mind, here the most important thing that in the real estate world, in my mind, is remember when you put property in joint tenancy, you only get 50% step up in basis. And when you have it in community property for a married couple, you get 100% step up in basis, which makes a huge difference when it comes time for the surviving spouse to sell the property. Could be the difference between paying a lot of tax and paying no tax at all. That's one thing. The other thing is just for anybody that knows somebody who owns a lot of property, the $11.7 million estate tax exemption actually went up slightly from $11.7 million. It's almost $12 million estate tax exemption is due to sunset on December 31st, 2025. And then that exemption is going to go back down to, I think it may even go down as far as $1 million anyway, or maybe it's $5 million. Anyway, we're going to lose a lot of our estate tax exemption after December 31st, 2025. So if you know anybody who has a lot of property that hasn't done estate planning and taken advantage of this exemption, either by gifting it out to relatives to avoid the estate tax, now would be a good time to talk about it. But this idea of gifting property to avoid estate tax, you got to be very careful because if you're not, you might actually wind up in a worse position depending on the size of the estate. I have an article that I can forward you the link, Bill. It talks about what happens when the wealthy suddenly perish. And it was published by a tax journal. And in that, I talk about what people with a lot of property can do to limit their estate taxes between now and 2025. Some very basic things. And it was designed not with the professional in mind, but with just the average layperson to explain how you can structure your estate to possibly avoid estate taxes. But this is an issue. Just today, I had a conversation with a woman. She's 86 years old. Her husband passed away, and she owns a lot of property. She said, we've been buying since 1970, and we've never sold anything. So, now we have to start looking at, what are we going to do to shelter some of that property from estate tax?
Just quick show of hands, who'd like to have so much property that you own that you create a massive tax problem that you have to go to David and drive him crazy researching the depths of the rules? Who'd like to have that problem? Just quick show of hands. I'm one of them. Yeah, I don't have that problem today, David, but I'm working hard to get that problem.
Well, I don't have the problem. I don't have the problem either. And my father, he used to always refer to that as a quality problem.
It is a great quality problem they have, and when I'm working, I'm not quite there yet, but we have enough insights. Okay, so look, it's time to wrap up because we're coming up in the hour here. David Ellis, CPA, you can get in touch with him at Ellis, N-Ellis, CPAs for the plural.com, Ellis and Ellis CAS.com. It's in the chat box. David, it's always a pleasure to chat with you. I'm so glad that you made some time for us today. I really appreciate you so much being here with us. Thank you so much.
Always a pleasure to be here. Happy to come back anytime. Thanks for having me.
Thank you. And we'll wrap that up today. This is probateweekly.com. We do every Thursday, 4 p.m. live. You can come into Zoom if you register there, or watch it live on YouTube or Facebook or LinkedIn where we stream live. Ask questions. Our goal of this is to be interactive. I'm a real estate broker, Bill Gross. You can find me on social media at Bill Gross EXP on YouTube, Facebook, LinkedIn, and such. Reach out if I can help. Call, text, email. Thank you so much. Make today your best day ever. Thank you so much.